Hello, everybody. Professor Barth is here, history professor at Arizona State University. What is quantitative easing? We're going to answer that in this video. QT, what the heck is it? You'll have a solid understanding by the end of this video. Last week, as you are aware, the Bureau of Labor Statistics announced that annual inflation jumped 7.5% in January. Now, the FOMC, the Federal Open Market Committee, the Federal Reserve, will meet on March 15th and 16th and make a decision about interest rates. They will raise rates by either 0.25% or by 0.5%. The last time the Federal Reserve raised rates by more than 0.25% was 22 years ago in the year 2000. But with inflation now at a 40-year high, they just might do it. The president of the St. Louis Federal Reserve, James Bullard, who's serving on FOMC this year, warned recently that inflation could, quote, get out of control, end quote, if the Fed doesn't take aggressive action. And he's saying that rates, the federal funds rate, needs to be a full percentage point by July. So we will see. The Fed released its minutes from their January meeting earlier this week, and it showed that they intend to begin quantitative tightening, QT, later this year after they begin raising the federal funds rate. So presumably the federal funds rate will go up in March, then May, June, July, and then we'll probably see QT launch in late summer or early fall. So, what is quantitative tightening? Quantitative tightening, or QE, is a reduction in the size of the Fed's balance sheet. Stated differently, it's a reduction in the number of assets owned by the Federal Reserve, and it's the opposite of quantitative easing. Under quantitative easing, the Fed purchases treasuries and mortgage-backed securities with currency, US dollars, created out of thin air in order to make those purchases. That treasury note then becomes an asset of the Federal Reserve System. The currency that the Fed generates and then uses to purchase that treasury note is transferred over to the account of the bond dealer, which is generally tied into the private banking system. One of two things happens to that money once it enters the account. The bank either stows it away in their reserve account at the Fed, increasing their reserve balance, in which case the money does not enter circulation, or the bank utilizes that currency and the money supply of the overall economy increases. Now, in March 2020, as the pandemic threatened to undo the entire economy, the Federal Reserve, as you see here in this graph of its balance sheet, massively increased its assets, launched an unprecedented program of quantitative easing. The Fed's balance sheet exploded. Here it is zoomed in. Look at that. Up by more than doubled. And these asset purchases continued deep into 2021. And as late as last fall, the Fed was still purchasing $120 billion worth of assets every month. $120 billion worth of assets every single month. And you can see here, this is the Federal Reserve's balance sheet as a percentage of GDP. Look at that huge jump in March of 2020, went from under 20% of GDP, the size of the Federal Reserve's balance sheet, to over 35%. So massive changes and drastic measures taken by the Federal Reserve in the midst of that pandemic. The yield on the 10-year Treasury, on US Treasuries in general, was very low, in large part, and dropped in large part because the Fed became such a major buyer of bonds on the market. When demand for bonds is high, the yield is low. In other words, government can borrow money very cheaply when the yield is low. As many different people, dealers, institutions, the Federal Reserve are competing with one another to buy government debt. This allows government to borrow money at a low interest rate, which in turn encourages governments to run major budget deficits. If you look at the 10-year yield between November 2019 and August 2020, it went down by 73%. Because, in large part, because of the Fed's involvement in the bond market, and there were some other variables at play there too. But that made a major difference. Now, unlike the quantitative easing that occurred under Ben Bernanke in the years after 2008, from 2008 to 2014, much of the currency that the Fed created out of thin air to expand its balance sheet, to purchase all those treasuries and mortgage-backed securities, much of that currency has entered the real economy. That wasn't necessarily the case after 2008, but it's the case now. And so the money supply, as measured by M2, has increased by more than 42% since the pandemic. This is the number one contributor to inflation. Now, as it became clear last fall that inflation was becoming a real problem, the Federal Reserve announced in November that they would begin tapering QE, that monthly asset purchases would be reduced each and every month so that all new asset purchases would end by July of 2022. Then, as the inflation data got worse in December and early January, the Fed announced that they were accelerating the tapering program so that all new asset purchases would end by the middle of March. Which means, by the way, that the Fed is still purchasing right now in February 2022. The Fed is still purchasing treasuries and mortgage-backed securities, and they're still expanding the size of the Fed's balance sheet, even as they announce that they plan to begin reducing the size of the balance sheet later this year, which is totally insane. I made a video about it last weekend. So this is unprecedented for the Fed. It's a very rapid shift from QE to QT. As we'll see in a moment, the Fed actually launched a quantitative tightening program several years back in 2017. But 2017 was a full 3 years after the end of QE under Bernanke. QE ended in December of 2014. QT, the last round of QT, began in October of 2017. So a 3-year gap. We're not talking about a 3-year gap this go around. We're looking at maybe a 3-month gap, or at a maximum a 6-month gap. Also in 2017, inflation was not a big problem. So we have not ventured into these waters. Now, there are 2 ways for the Fed to pursue quantitative tightening. 2 ways in which the Fed can reduce the size of its balance sheet. The one is more gradual, the other is more aggressive. The question remains, how aggressive will the Fed be in quantitative tightening? The first and most gradual way is to simply allow its bond portfolio to roll off as bonds mature. The second and most aggressive way is to outright sell assets before they mature. Under a moderate QT program, the Fed allows bonds to roll off as they mature. Ordinarily, when bonds mature, the Fed replaces those same securities by reinvesting in new securities. And so the Fed's Treasury holdings don't ordinarily decline even as bonds mature. They just replace them. They reinvest. Under moderate QT, the Fed won't necessarily replace those bonds. The US Treasury will pay cash to the Fed at the maturity of the bond, but the Fed will decline to reinvest. And so the cash that the Treasury pays the Fed disappears. It's entirely ejected from the system, and the Fed's balance sheet, by consequence, decreases gradually. And the graph we have here is a graph of the Fed's balance sheet. And you see, this is from a couple months back. Treasury holdings in the blue and mortgage-backed securities in the yellow. And this is the year in which these holdings mature. So you can see there are, in 2022, over $1 trillion worth of treasuries on the Fed's balance sheet that are set to mature. Under moderate QT program, the Fed would either only replace some of that $1 trillion or none of it. They would just let it roll off, and the size of the Fed's balance sheet would decrease by over $1 trillion. So you can see there's quite a good chunk of the Fed's balance sheet is actually set to mature in the next few years. Now, this form of moderate QT is precisely what the Fed did in late 2017 through early 2019. At the peak of the QT program in 2018, the Fed allowed up to $50 billion worth of securities every month to mature and not be replaced. So here's a graph of QT in 2017, 2018, and there was a monthly cap on how much the Fed would allow to mature and roll off the balance sheet. The program ended in 2019, and so it was very brief, quite moderate. From October 2017 through March of 2019, the Fed's balance sheet shrank by $500 billion, or by about 16%. So it wasn't major quantitative tightening, but still $500 billion decrease when your balance sheet amounts to $4.5 billion is sizable enough. Now, the Fed in 2017, first under Yellen, and then Powell replaced Yellen and continued the program. The Fed in 2017, 2018 never directly sold assets. It didn't sell assets. It just allowed the existing holdings to mature and roll off. And even, again, some of the light blue here are treasuries that matured and the Fed replaced, reinvested. Janet Yellen, Fed chair at the time that this round of QT began, said, "Oh, it's not a big deal. It's very moderate." She compared the process to, quote, watching paint dry. Like, even then, even with this moderate program of QT, the yield on the 10-year Treasury jumped from 2% to 3.25% before the Fed stepped in and aborted the QT program in early 2019. But the 10-year Treasury yield jumped by 58%, and the yield on the 10-year jumped because the Fed wasn't buying as many Treasury notes as they were previously. Okay, more on that in a moment. So the Fed can take this more moderate route of simply allowing bonds to mature off the balance sheet. But this policy, in my opinion, this policy alone will not be enough to get a real grip on inflation. To do that, the Fed will need to sell assets outright even before they mature. Some analysts, like the St. Louis Federal Reserve president, who's serving on FOMC this year, have suggested that this may indeed be necessary to resort to this more aggressive QT program. And if so, if we have aggressive QT, we're talking huge consequences for the economy. With this more aggressive form of QT, the Fed will sell treasuries that have not yet matured. They would be sold on the private market, and the cash resulting from the sale would be ejected from the financial system. Potentially trillions of dollars in liquidity could be drained from the market. The impact would potentially be devastating for treasuries, for the mortgage market, for the government's ability to finance massive deficits every year. All necessary, however, in order to prevent inflation from spinning out of control. And there is a very real risk here of inflation spinning out of control. You think what Paul Volcker did back in the late 70s and early 80s was fun? You think that people liked that, undergoing that? Well, he had to do it to stop the inflation from further spinning out of control, because it was already out of control. But to prevent it from really going haywire, Volcker had to hike those rates up. And so aggressive QT may be necessary. And this came out in the FOMC's minutes from January. Look at this. At the meeting, participants agreed that details on the timing and pace of balance sheet runoff would be determined at upcoming meetings. Participants generally noted that current economic and financial conditions would likely warrant a faster pace of balance sheet runoff than during the period of balance sheet reduction from 2017 to 2019. Stated differently, QT is going to have to be more aggressive than it was in 2017, 2019. It's going to be more aggressive than that. Participants observed that in light of the current high level of the Federal Reserve's securities holdings, a significant reduction in the size of the balance sheet would likely be appropriate. So one way or the other, moderate or aggressive, QT will inevitably increase volatility in the bond market. As the Fed exits the bond market, as the Fed no longer functions as the bond buyer of last resort, the private sector will have to step up and become the primary buyer of treasuries. Look at this graph here. This is the percent of total outstanding treasury securities in possession of the Federal Reserve. Prior to the pandemic, less than 15% of treasuries were owned by the Federal Reserve. Now we're looking at 25%. If the Fed exits there, that's going to leave a major vacuum. Can the private sector fill it? The problem is liquidity won't exist for the private sector to buy up all of those treasuries at such a low rate of return. I mean, the 10-year, it's been under 2%. That's a low yield. So with the Fed exiting the bond market, however gradually or aggressively, demand for treasuries will fall, and that will be reflected in a higher yield. You'll see the yield for the 10-year treasury note rise. The government, stated differently, will have to pay a higher interest rate on newly issued debt. And this is for a government that is addicted to debt. This federal government cannot help itself. It's just debt, debt, debt. Well, what happens if you have to pay a higher interest rate on that debt? So we've long been in a bond bubble. The Fed has given artificial stimulus to bond markets through QE. What happens when you remove that stimulus? The bubble pops. Treasury yields go up. Bond prices crash. See, there's an inverse relationship between bond prices and treasury yields. They move in opposite directions. As yields rise, and you'll see those yields rise, those yields are rising. As yields rise, prices for existing bonds fall. If a bondholder, whether an individual or an institution, wishes to sell a treasury note before maturity, they will need to sell it at a lower price than the price at which they purchased it. People don't want to go pay for an older bond with a lower fixed interest rate when, for the same amount, they can purchase a new bond with a higher fixed interest rate. And so if you want to sell your older bond on the secondary market, you've got to sell it at a discount. Otherwise, nobody's going to buy it. They're going to buy the newer bond with the higher fixed rate. So you're going to have to sell it at a discount. Prices for existing bonds fall as yields rise, since the higher interest payments on new bonds look more attractive by comparison. To sell an older bond that's not yet matured on the secondary market, you must sell at a heavily discounted price to compensate for the otherwise lower yield vis-a-vis the newly issued treasuries that carry a much higher yield. Financial institutions that possess large sums of treasuries, if they have to sell those treasuries before they mature, those institutions will take a major hit. All right, they're going to take a major hit because they won't be able to sell those treasuries on the secondary market at the high price at which they originally had purchased them. And the extreme financialization of our economy means that this could have a real domino effect across the entire system, especially if bond prices take a real nosedive as yields shoot up. So this has major consequences, what happens in the bond market. Again, going back to the FOMC minutes from January, participants who commented on issues related to financial stability cited a number of factors that could represent potential vulnerabilities to the financial system. A few participants noted that asset valuations were elevated across a range of markets and raised a concern that a major realignment of asset prices could contribute to a future downturn. A couple of these participants judged that prolonged accommodative financial conditions could be contributing to financial imbalances. In other words, the Fed's contributing to this. All right, all this stimulus, all this QE has contributed to these artificially high asset valuations, and bonds are included in that among those. Some participants saw emerging risks to financial stability associated with the rapid growth in, of course, they're going to target this, crypto assets and decentralized finance platforms. The Fed really hates DeFi. I'll need to make a video on DeFi sometime. A few participants pointed to risk associated with highly leveraged, this is key, highly leveraged non-bank financial institutions, or the potential vulnerability of prime money market funds to a sudden withdrawal of liquidity. What happens when liquidity becomes scarce? What's the impact of that? Now, depending on how the bond markets react, even the more gradual form of QT could be very disruptive. But if the Fed moves beyond simply declining to purchase new treasuries and begins selling treasuries on the private market, that could really cause the bond market to spiral. So much so that the Fed might even tolerate double-digit inflation before they would allow a bursting of the bond bubble. Goldman Sachs is ringing the alarm about the volatility in the bond market that would result from an aggressive program of quantitative tightening. JP Morgan is predicting the beginning of QT in September with $100 billion a month reduced from the Fed's balance sheet. That's JP Morgan's prediction. And then you look at the charts. The yield on a 10-year note is already up 15% since the beginning of January. In fact, it went over 2% earlier this week. It's down a little bit now. And then if you look at the 10-year since August, when all the talk of inflation really started to pick up and tapering and possible quantitative tightening, the yield is up 65% from August. 65%. And if you take it even further back to August of 2020, man, can you believe that? The yield on the 10-year was a little over 0.5%, which is nuts, man. Up 273%. If you purchase treasuries at this in the summer of 2020 and fall 2020, okay, you made a very poor investment decision. All right, you made a very poor investment decision. So that's what's happening with the yield. And if you look at the historic chart, this is the market yield on the 10-year note. Look at that. Where we are now, I mean, it's really, like I said, this has been a bond bubble. The yield on the 10-year note historically through the 90s was above 5%. Look what happened when Volcker hiked interest rates. Look at what happened to the yield. Went above, at one point, above 15%. All right? In this market today, it goes above 2%. And people are like, oh my gosh, over 15%. So, in other words, there's a lot of room here for movement. And the higher this goes, the more the more the ripple effect would be huge. Which is why I think, again, I don't think the Federal Reserve will even let it get there. The Federal Reserve would rather have a lot of inflation than that. Another wild card is the repo market. A repo or repurchase agreement is a short-term, usually overnight collateralized loan with Treasury serving as the collateral. Repo market is very important for large financial institutions like investment banks. Must borrow cash to meet overnight liquidity needs. An estimated $1 trillion per day in collateral value is transacted in American repo markets. So repo markets are huge. Now, last time the Fed tried quantitative tightening, even though it was quite moderate, it contributed to a major spike in the repo rate in September 2019. Markets freaked out. Cash liquidity became very scarce. Fed responded by lending in the repo market and restarting QE. So you see this? Isn't this interesting? This was QT. Fed's balance sheet was shrinking, and then the repo markets freaked out. The Fed freaked out. And whoop, right back to QE. Man, Trump didn't like this. Trump did not like this. He was real critical of this. But the Fed ultimately did what he wanted and went back to QE. Fed restarted QE, and then COVID just went wild. Who would have predicted in late summer 2019, who would have predicted that the size of the Fed's balance sheet by February 2022 would be close to $9 trillion? And now, this time the Fed's going back to the repo market. This time the Fed says it's prepared for volatility in repo markets through a standing repo facility to inject short-term liquidity, as much as $500 billion of cash overnight to the banking system, and that would be used to calm down the repo market if need be. But this is an entirely new facility, so it remains to be seen if it could head off another crisis in the overnight lending market. So, to conclude, none of the options that the Fed is facing down are pleasant. Okay, let's be frank here. Zoltan Paskar is his name. He's a former Fed official, or former official at the New York Fed. Now he's with Credit Suisse. He said the Fed needs a Volcker moment. A Volcker moment. Well, shoo. What does that mean? You know what that means. That means quantitative tightening and rate increases. The Fed is clueless what to do. This was from Zero Hedge today. Fed desperate to figure out how to start a soft recession without also crashing the market. So yeah, the hope is that they could slow down inflation by engineering, as Zero Hedge calls it, a quote soft recession, preventing inflation from spinning out of control while also avoiding a crash in the markets. But good luck doing that. Good luck doing that. To Larry Summers, former Treasury Secretary under Clinton, 2 months ago said there have been few, if any, instances in which inflation has been successfully stabilized without recession. And again, I hate to be a dead horse, but the Fed is still buying assets. Remember that. The Fed is still buying assets as we're talking about QT. Still doing it. QE doesn't even end until March. Okay, the whole thing's madness. Right? The whole thing's madness. Hey, if this is your first time watching a video from myself, check out my History of Money course, subscribe to my channel, and it's a pleasure to check in. I'll talk to you all soon. Until then, God bless.